it's a power suit, it's glamour, it's a seat across the table, making deals. But power is also the moment when you own your vulnerability, the moment when you own the things that we've been told are failures, things like being born poor or being born with a disease that is out of your control, feeling unseen and unheard in a world that doesn't celebrate who you are, a world where you're passionate about things that you can't articulate to the people that you love, or passionate about things that aren't in the zeitgeist. This is also power. And us owning that power, redefining it into the work that we do, is precisely what we get on stage today at the Forbes Africa 30 Under 30 unveiling. I want to commend the inspirational stories that we just had on stage. And if anything, I think it should tell us that success has its fair share of struggles, it has its fair share of strife, it has its fair share of tears. These are not things to be embarrassed about, these are things to own in your story and in building your big ideas. So thank you so much to all the people that just spoke now, and if you could give them one more hand. Now, our program only gets better from here. In our first panel discussion, we talked about what are the thought processes that we each need to get into when building our next big idea. We now talk about big money. Once I have the idea, how do I unlock finances? How do I speak to investors to get them to buy into my product? How do I get them on my side? And what mistakes am I making as a startup who's in the market trying to get funding? As the panelists for this next panel come up, let's welcome them with this short video introduction.
Joining CNBC Africa senior anchor Fifi Peters on stage now are Pholo Leteka, Executive Director and Founder at IDF Capital, Managing Partner and Co-Founder at Alethea IDF Managers. Pholo Leteka is a highly accomplished and experienced entrepreneur and private equity investor. Through IDF Capital, she has contributed towards channeling investments into women-owned SMEs across South Africa. Luke Dominic Warner, Founder and CEO, Integrate Me. Luke began his entrepreneurial journey at the age of 6, selling products door-to-door in the southern suburbs of Cape Town. In 2019, Luke and the Integrate Me team raised 32 million rand through equity crowdfunding in 10 days, breaking records on the African continent. Sid Wahi, Managing Director of CMA Investment Holdings. Sid joined the family business in May 2010 and serves as CEO and Executive Director of ABN Publishing. He is a board member of numerous ABN Group companies, including CNBC Africa. David Moore, Head of Alternative Investments at Alexander Forbes Investments. David's career spans 11 years in the financial services industry. He is tasked with building scalable, diversified, and high-performing alternative asset portfolios in South Africa and the rest of the continent.
Hello, everyone. Hi. Such a nice introduction. So good to be with you. Myself and my panelists, we were actually joking in the speakers room about how many of us are not under 30, so therefore by right we shouldn't actually be here, but we elbowed our way in here, right? We're hoping that you can certainly learn something from our age. They say age departs wisdom, right?
So they say.
Hopefully. Right, so we're going to be talking about something that a lot of you guys face in terms of a challenge. You guys might face it in terms of starting out. You might face it in terms of scaling up your businesses, and this is about money. I don't have to introduce any of you guys because the profiles have already been established, but I would like to get the conversation going with Luke. And Luke, because you this month made history. You raised 32 million rand in record speed on a platform that is not very popular here on the continent, being equity crowdfunding. My question to you is, why do you think that so many people bought into your idea? and thought it could work?
I think a key point is I didn't raise 32 million rand. We raised 32 million rand. It was a collective effort. It was my co-founders, my company, all of my staff, all of our business partners, all of our customers, all of our users, all of our suppliers, all of our vendors, and everybody in our day-to-day community, our security guards, our coffee ladies, the reception ladies, my Uber drivers. So we did that. It wasn't a one-man show.
All right, now that you've given a shout out to all your partners,
Please.
explain the dynamics of crowdfunding and exactly why you think it worked so well for your business.
Cool. There are some themes that Bonang spoke about earlier where as you grow, you network and you build connections and you see people on your way up and down the escalator. Over the 3 years of our business, we had built those relationships with our community and ecosystem. And so these people believed in us and what we were doing on a day-to-day basis and what we are still doing. And they gave us money because they believed in our story, but more importantly, they saw that come hell or high water, we believed in our story every day. And so that's why we were able to raise it. Uprise Africa was a key part of the journey. They're a startup themselves. They're a reg tech startup. The regulatory component is being able to take money from the man in the street and the FSB license behind it. That's their core strength. Their secondary strength is putting the technology in place to automate it. And it was just an amazing opportunity that we found them when we did, because else we would have taken another private equity round, which may not have allowed us to execute on our true vision and purpose for starting the business.
Okay.
So.
All right, thanks, Luke. Just a bit of a disclaimer. I'm one of the ordinary people on the street that Luke sold his fantastic idea to. So if I am being biased, Luke, yeah, you better make me money, but yeah. Sid, you are also an entrepreneur who is well-versed in raising capital from different funding platforms. Luke said to me, he said, it's not about chasing money. Money will chase a good idea. Investors will chase a good idea. And I'm hoping that Apollo and David can weigh in here. But in your experience, has it been that easy? Is it just about an idea when you've gone knocking on doors for money?
So, I think it's a combination of factors. We heard somebody use the term MVP earlier, minimum viable product. So it's a lot easier to raise cash if you have something to show for it, rather than have just an idea without any execution. So that's definitely one component. But I think more important than that is the story that you tell to your financiers. They have to believe in you as a person, and in that comes your own personal track record, your own integrity. You don't want to be the kind of person that raises $10 million and then the first thing you do with it is buy a Ferrari. So you have to really be diligent with how you spend money when you are raising it. So yes, there are those other factors. And then, of course, it's the business that you ultimately are involved in, and the business planning around it, the assessment of competition, the having the vision to forecast your financials over a 12, 24, and then 36-month period, and showing some amount of progress around those times. So absolutely. I think at this point I'd also like to mention that it depends, when you're raising money, it really depends who you go to, and that will also justify the difficulty. If you're raising money for a startup and you go to friends and family, I'm pretty sure I can walk up to my dad today and say, hey, I need $50,000 to go and do this thing, and it might be an easier sell, because he's a bit biased. But taking the same idea to a private equity fund or a DFI, they'll probably tell me to go take a hike. So,
no, for sure.
Yeah.
And that's quite an interesting point that you raised, because Bolo, when you and I were talking, you were talking about how important it is for entrepreneurs who are looking to raise money to know what stage of their business they are at and what type of funding to access. The distinction is important.
Yes, absolutely. I think a lot of entrepreneurs make the mistake of not doing a due diligence on investors. So we often think that it is investors who have to do a due diligence on an entrepreneur. But I think it's equally important for entrepreneurs to do a due diligence on investors or funders, because that will then help you to understand the type and profile of the financier. Are they looking for high returns? Are they looking for low risk and therefore pedestrian returns? But you also need to understand the type of capital your business needs, because if you are, for instance, a tech startup, you probably are very cash hungry, and you will remain that way for some time to come. So it wouldn't make any kind of sense for you to go and try and raise debt funding, because debt funding by its nature is supposed to self-liquidate, meaning that you have to be able to service it. So you then have to find financiers or investors that are long-term, looking for growth, growth opportunities.
Like
and
David.
Of course, yes, of course, and then of course are looking to then make the higher returns. Having the right risk profile, appetite as well, because that is one of the things that I think entrepreneurs don't have an appreciation of. So a bank's risk profile and appetite is, completely different to that of say a venture capitalist, to that of a private equity funder.
Okay. I mean, talking about the long-term funders like yourself, David, working for a pension fund company, looking to make use of our money until we get, 65 or 70, and then we need it back again. So you wouldn't necessarily give money to a Luke or a Sid. You'd more likely give money to a Polo who goes out and has various funds that will invest in Luke's business or Sid's business. But ultimately, what makes you say yes to that kind of funding?
Sure, and 100% correct. So we're, at Alexander Forbes, we're a multi-manager, so we're a manager of managers. And what kind of ticks our box in that context is really, we're giving money, pension money, long-dated money, 10 to 15-year time horizons to people to manage on our behalf, or on the behalf of our clients, which are pensioners. And so the three kind of key aspects to unpack as part of our due diligence with that manager is team, because people ultimately need to work together and stay together, and 10 years is a long time in people's lives, and so priorities change, personal situations change, and incentives change, and you'd be surprised how difficult it is to keep a team together for that period of time. So finding stable, consistently motivated team members that have a shared vision, ideology, and actually like working together is kind of your first tick box. The second one is track record, so a repeatable track record in the proposed strategy or investment thesis they are pitching. So that, again, is also, in the first-time fund managers context, which I think is probably most relevant to this audience, you don't often have track record that's wholly relevant, so you have to piece it together between the team members and then sort of figure out who's complementary and who works well together, and you need to find the originator, you need to find the analytical back-office individual, you need that complementary skill set to drive a strategy and create momentum behind it, and then that track record needs to translate into the strategy that they're ultimately pitching to us. And if there's disconnects in any one of those three, very, very difficult to with any good conscience allocate money for 10 years.
Mm-hmm. Because I mean, ultimately, the conversation about the access to funding for many young business owners, and especially female business owners, is something that we talk about all the time, and it doesn't look like it's getting easier. So we're having a conversation right now, and it sounds a lot easier than it is out there in the real world. So why do you think young people, many of them who are in this room, continue to experience hardships in getting money for their business? Boldo?
Sure, it's a myriad of reasons, to be honest with you, Fifi. Sometimes entrepreneurs don't do the homework around what does my business really need. What we have found is that oftentimes when people think they need money, they actually don't need money. Maybe they have a huge debtors book, and if they can collect on their debtors, they actually will be sufficiently funded for their needs. So we spend a lot of time unpacking what the rationale is for people raising funding, and to the extent that it makes sense and we can see how it's going to contribute towards the growth of the business, or growth of the business and making it profitable, then you think about funding it. But oftentimes you find that it really is, they're probably not making money because of structural issues. On the other hand, it's also just lack of clarity of your value proposition. You need to convince an investor that if you're talking about an equity investor, if they are going to put 10 Rand into your business, in 5 years' time, they can get 100 Rand out of that business. And you have to be very clear about exactly what it's going to require for you to do that, and exactly how you're going to do it. And your story has to really be convincing, because a lot of the time, and I think, is it Luke Sid who mentioned it, that when you're at an early stage, whether you have an idea or even you're at an MVP, probably pre-sales, it's very difficult for you to convince anybody that you've got a business. Mm-hmm. So that's where then your track record, your personal track record, the skin in the game that you've put in, the bootstrapping becomes really very critical, because investors want to see that you've also got something to lose, especially if they're going to come in at a very, very early stage.
Sure. Sid?
Just to add to that, if something is a good idea, it's a good concept, it makes sense, it's not necessarily a good business proposition. So it's not always a good business proposition. So I think that is one of the challenges. The second challenge is that running a business is not glamorous. I think Linda spoke about this earlier, the struggle of paying salaries at the end of the month, dealing with collections and debtors books. I mean, these are a lot of things that a lot of first-time entrepreneurs are inexperienced. They have a good idea, they're a good chief idea officer, but not necessarily a good chief executive officer, not a good operator. And I think that is where they need to, again, I think this was said earlier, you don't need to be able to do everything. You should be, it's fine for you to be the idea person, but then bring in a good business person who understands how that part of the business works.
That's so important, actually.
Or even bring in a good talker, because, I mean, Luke, for you, what sold me was the fact that you said that if you don't invest in this today, tomorrow you are going to be sorry. And it's more than just the idea, though. You need to have very strong communication skills. You need to have very good marketing skills. You need to have confidence for days. And how did you cultivate that? If you could just share that story for us.
Let me just expose some vulnerability. I think we need to change our words. The reason they call it spelling is you're casting a spell. So as much as I can computer program and code, every time I'm talking, I'm programming the environment around me. So let's stop saying invest in my idea or I have ideas. Everyone's got ideas. Say invest in my business. I have a great business. I've got customers. Throw the word idea out because I have 4,000 ideas every hour. They're not all businesses. So say this is my business. I've just raised 32 million bucks. I've got tons of customers and stuff, and now I'm trying to do a management buyout. And I've got 10 proposals sitting on my desk, and I sit with people and I must go redo my financial models and stuff, and you've got to hear no 10 times a day. Minimum for every 1 yes, you must accept 9 proper, your idea is stupid. Even if you think you're great. So success is due every day. It's like your rent. It's intentional, and you have to get up and dust yourself off every single day. I've raised this cash now. I've got new problems. So I love what you said about the due diligence part. So people go to investors and they're like, they said no to me. You didn't even go to the investor's website and say, okay, I only invest in oil and gas and agriculture. Now you want to go to him with a health tech thing. It's about compatibility. So you got to see, am I compatible with what's happening? So most entrepreneurs which don't make it are saying, give me the money, then I will figure it out.
Yeah.
Not, let me figure it out with the small resources that I have today, and then go back to the investor. And when the investor says no, say, what do I have to change for it to be a yes?
So what's quite interesting is that David, in his previous role, was an investor who said no to Luke's idea.
Business.
David,
Luke's business.
My correction. I think I'm in line.
Cool.
Thank you. David said no to Luke's business in his previous role. He was working for a completely different institution at that time. David, tell us more and tell us why you think that institution also needs a bit of a rethink, particularly in these times.
Yeah, I think it's what Luke and Paulo touched on. It's a function of knowing your investor. And at that point in time, the institution that I'd worked for, we hadn't fully articulated our appetite for investing in this specific space, which is earlier stage and slightly riskier than what we'd potentially been used to. And so the timing was a bit of an issue. And, progress subsequent to that, they may have now articulated a better risk appetite for the space and now are allocating into that space. So I think it comes down to knowing who your investor is at any given time, knowing what their priorities are, and then targeting them and creating a magic word that we actually chatted about beforehand, FOMO, amongst the investor community. You wouldn't believe how many businesses and or fund managers attract money on the basis of having a certain investor in the investor mix. Because investors look and go, well, what did they see that I didn't see? And all of a sudden, you create some momentum and you get another investor in, and everybody crowds each other in. As much as you think it's sort of, you need to talk to everybody independently, and investors talk to each other and screen ideas.
I mean, so I'm just wondering, in this age that we're living in right now, where you've got technology that can connect you to a whole host of people everywhere that can scale you up, going to traditional investors, your banks, even your private equity players, I'm just wondering, given the success of your crowdfunding platform, which I imagine was a lot cheaper form of funding, or perhaps you can color me there, Sid, is this what we should be leveraging now when we're also thinking about accessing funding, leveraging technology and these new innovative ways of raising money as opposed to going to your banks and your pension fund managers like David?
So I don't really have a comment to make on the new and innovative ways to raise funding. Maybe we can talk a little more about crowdfunding. Luke can talk a little bit more about that. But what I will say is don't go to the bank if you want to raise money for a new venture. Only go to a bank if you have cash flow and you have a short-term need. Do not go to a bank for anything else.
All right. Why?
They won't back your idea. Banks, they have these departments called the ones that look after credit risk, right? And they look at your idea and they say, this is not a bankable project.
Okay.
They look at your balance sheet, they look at how much cash you have, they look at assets, your debtor book, they look at a range of factors, which you will not have as a new business.
Luke, you raised your eyebrows when I said that crowdfunding was potentially a cheaper form of raising cash, no?
So again, you got to see things as tools in your toolbox. So like the same with martial arts, you don't just have like one spinny fly kick. You got lots of techniques, and then you see where the gap is in your opponent. And if I'm a handyman or a mechanic, I've got all my tools, but then I go look at the car or the house, I see what's wrong with that. Then I go get the tool that's right for that job, whether it's a saw or a screwdriver.
Okay.
So financing as well. I personally think that crowdfunding is not a silver bullet, but it's a great mechanism if you have a consumer-facing business model where the consumer, the man in the street, is going to have a lot of benefit from it. Because then they can invest it. You can get something called what's called market validation with crowdfunding. If somebody, even starting off your business, you don't even need $1,000. You go run around Santon City and say, cool, everybody give me $50 to be an early adopter to join my waiting list. Then that shows you, hey, people are either going to say, no, this is dumb. You say, okay, well, what must I change for you to give me this 50 Rand? So crowdfunding was that perfect tool to say, cool, I can get 1,000 Rand from the man in the street up to like $5 million. So for me now, I can say I've got 420 people which have something to lose, but they've also got a lot to gain.
Yeah.
So the whole crowd can't be wrong if I go to one of my large bank and telco clients now and they say, let's white label solution. I say, no, all of these people have paid money. They say they want my solution, they trust my brand. So crowdfunding, it costs 8% plus VAT for the funding route, so it's a bit more expensive. But it's also a marketing tool at the same time to get what's called market validation.
But it's like what you said about knowing which types of funding to access at different stages. And if you'd just like to add in there. But also, Polo, I mean, in your experience, you've had so many entrepreneurs come and pitch to you, not only on Dragon's Den South Africa, but in your day-to-day life. Ultimately, what is that thing that makes you say, I'm in?
You're doing a play in the book. So I actually wanted to come in on what Luke was just talking about now. We call it looking for intelligent capital. You know, looking for funding is beyond the actual cash that you receive in the bank. It's also about who gives it to you and what else do they bring to the table. And I think it's very, very important for entrepreneurs to understand where they are in their business cycle, what they need at that point. Because a lot of the time, I mean, David spoke about the team. Team is very, very critical. And sometimes you cannot afford the team. But if you can get an angel investor who has got some time on their hands and they've got lots of knowledge on how to run a successful business that is relevant for your business, you could actually get capital plus intelligence, you know, just through the writing of that check. So I think we have to be very creative around how we source capital and who we source it from, understanding what else they bring to the table. I think what makes me in, or what makes me say I'm in, it's probably the jockey. I would say we spend a lot of time, talking to the entrepreneurs, understanding their personalities, understanding how hungry they are, understanding, their drive. Are they the type that will give up if they come into trouble, or are they the type that will stay, the race? How prepared are they? How much have they put into it? And it doesn't necessarily mean how much money, but it could also mean how much time, how much research, and any other form of, building the business case. And that often is carried by the entrepreneur. That often is carried by the individual who's pitching to you. Especially when you do early stage businesses, you remember that you don't have a track record of, sales to look at or a balance sheet to look at. You're looking at the person. And if the person has done their homework, and importantly, they also have either the relevant technical or industry skills, or they've got a team around them that will augment whatever gaps they might have as individuals. So ultimately, it is the jockey, but the jockey is almost made up of quite a number of elements.
And David, to what degree the economy right now, South Africa in recession, many countries on the continent in a tough spot. In fact, only a few bright spots there. To what degree are the economic hardships that many African countries are facing a limitation to the ability of entrepreneurs to get money?
Yeah, I think the macroeconomic situation is what it is, and it's really challenging right now. However, I think from a long-term investor perspective, potentially, you counter-cyclical in terms of your thinking. If you're going to be deploying money for 10 to 15 years in SA and Africa, when corporate South Africa is struggling and earnings are depressed and asset valuations are depressed, the time is now to actually invest. So you just need to find the right investor with the right risk appetite, with that right frame of mind to really garner investment.
Right. Sid, Luke, I'd like to give you the closing remarks for this conversation. 3 minutes, so that's 1.5 minutes each to split. Also, as you do close, perhaps, lessons learned from your experiences in raising money that you could depart to these guys so that they don't have to walk that path.
Look, there's a lot of wisdom on the panel, so I'm just going to talk a little bit about equity and trying to preserve equity as much as you can. So when you are raising money, don't be in a rush to give away pieces of your company. Try and retain most of that equity for as long as you can, because you're going to grow and you're going to scale up, and you're going to get to a point where you're raising money at a particular value from a PE fund or even a venture capital fund, and that's when they're going to really kind of try and take blood out of a rock. So when you're starting up, try and self-fund it as much as possible. Try and fund it from pre-sales or from advance payments, things like that. Max out your credit card, but don't give away equity. That would be my advice.
All right. So no listing on any stock exchange anytime soon.
No.
Not for you, Luke.
I think just that idea that you can actually do so much with so little. You don't need the money first. Just start right away. Get action. Get going, and know that. Every time, for me personally, even just being on this panel, it's like, oh wow, Forbes. But guess what? I've got to wake up tomorrow morning and then carry on with my life. So every day, take action towards your goals.
No, perfect, and a perfect perfect position to finish it. Guys, thank you so much for your time, and I hope that you guys were inspired, and I hope that you certainly learned a lot more about how to get that oil into your machines, and that is your businesses, in the words of Luke. Thanks, and it's bye from us.
That was fun. Thank you.
That was fun.